Let's get a bit more clarity on what's governing the trade in these commodity markets. Jay Taylor is President and CEO at Taylor Hard Money Advisors and joins us from New York. So, Jay, is it too simple to say if you believe in the long-term bull cycle, you buy on this kind of pullback?
Yeah, I suppose that, I don't know that, I think that's an oversimplification. Actually, I'm not convinced in the bull market in commodities, let me say that I think that there's going to be some very, very significant pullbacks because I believe that the global economy, at least the U.S. dollar denominated global economy, with the U.S. dollar being the reserves currency, I mean the world's reserve currency still, I think is problematic because of the enormous indebtedness of the United States. So I think there's going to be a lot of upheavals, and of course these commodities are denominated in U.S. dollars. So I think that we have a lot more debt liquidation to go through in the global economy. And when you have these massive debt implosions, as we had after Lehman Brothers, and I think we'll get more of them, then you're going to see some very substantial declines in commodity prices, because I believe a lot of the commodity rise here is not really based on strong economic fundamentals, but rather on a lot of hot money, QE2 money, if you will, that's being pumped in by speculators, by hedge funds and the like, that are buying commodities. And I say that on the basis of my observation of the markets that should be the leaders in a growing economy. The auto markets, for example, the housing market should be a leader if we had real strong growth. It's certainly not true in the United States, whereas it may be somewhat true in China. But at least from where I sit in the U.S., we're not seeing a strong economic story here. And so I think there's an awful lot of speculative value into these commodity markets.
That is an absolutely moot point that you raise, and it seems that the CME is on this mission to shake out the speculators from the commodities market by increasing margin limits. Is that what's happening?
Right. Well, I think that's part of what's happening, certainly, but I think there's also a political will to try to knock down competitors to the U.S. dollar. I mean, let's face it, the status quo doesn't want people to think in terms of stuff. They don't want, American policymakers don't want to see Americans go out and buy gold and silver and use that as money and think of that as money. So I think there's a lot of speculation, and I don't think it's unhealthy to see a major pullback in the commodity markets at the same time. But I believe there's also a huge amount of offtake, a demand for physical silver and gold and other metals that ultimately will win, because I think people are losing confidence in the U.S. dollar. I think that is absolutely true. And the last people that will lose confidence, though, in the U.S. dollar will be the average Americans. Mostly, I think you're seeing it come from large, sophisticated investors and central banks overseas.
Yeah, talking about large, sophisticated investors. Let's talk about hedge funds for a while. Roger Ottenau, I'm sure you've been following that case. 14 counts convicted. We had hedge funds clamping down, self-policing themselves even before this conviction came out. What is this going to mean in addition to the CME raising margins on things like oil, on silver, etc.? I mean, this pullback, how much more does it have to go, do you think?
I don't know how much is related to this particular case. I rather doubt that that's that significant. I just think that I think that what happens when you start to have credit issues, that you start to see a stronger, quote unquote, stronger dollar, because let's face it, the U.S. dollar is still the world's reserve currency. It has the most debt. So when you unwind the risk trade, people have to make good to the margin clerks, and they have to sell what they're able to sell, not necessarily what they want to sell. And so they're selling what they're able to sell, and with that, then the dollar gets stronger and commodities get weaker. And I think that's part of what we're seeing. I don't think that this criminal case is going to have too much to do with it longer term.
Jay, if you do have a stomach for this kind of volatility, and if you do want to buy in at these levels, then how do you do it? Is it through the physical ETF or through some of the miners?
I'm not a big fan of the ETFs. I think there are ways that I tell my subscribers and my clients basically to buy. I like to buy CEF, which is the Central Fund of Canada. That's the Gold and silver, that's one way to do it. You want to buy the physical, store it if you have the capacity and a place to do it. That's where I would start. The miners, yes, I think there's some excellent miners. And actually what I really watch is the real cost, the real price of gold, the real price of silver. If silver and gold are rising relative to other commodities and other cost factors, then the mining stocks are looking very good, and they are looking very good now. The profits for the major U.S. gold producers are rising very, very strongly. And my sector is down market, the sort of smaller companies that are going to be the huge beneficiaries. The smaller guys are the guys that can efficiently find the metals in the ground. They're much better at it than the majors. But when the majors are profiting and making big profits as they are now, because the real price of gold has risen, the real price of silver has risen even more, then that's a good thing to look for, and that is very, very promising right now. Ever since the Lehman Brothers decline, I might add, and the 2008 equity market and credit market debacle, that has been very, very good for the gold and silver miners.
All right, listen, Jay, got to go. Great to talk to you. Thanks for the time. Jay Taylor, Hard Money Advisors.